My name is Daan Deurlacher, one of the founders of Americans Overseas. You may already be familiar with our organization. We provide information to Americans living abroad and about tax obligations and help them with a network of tax experts. Due to the increasing demand for investment opportunities, we have decided to also partner with financial advisors. Investing as a US person can be complicated, especially if it's a new matter for you. I would like to introduce you to Dunhill Financials, a financial advisory firm specialized in investing for Americans that live abroad. I would like to introduce you to Brian. Brian and his professional team have a lot of experience and knowledge about what good opportunities there are for you. In this webinar, we will share a lot of information. Afterwards, you will be approached individually by Dunhill Financial to look at your options together. If you have any questions, you can always contact us.
Thank you, Dan, and welcome everyone. Another great day for a webinar. It's raining and cold outside, so we'll get to cover a lot of things today. Thanks for joining us today. We're going to cover all the gambits, but please keep all your questions right there. You can ask them in the chat. There's members of my team. There's members of Dan's team that are online, and they'll be able to take part in those chats early on. And otherwise, we'll get to all your questions in the Q&A. So I'm going to jump right in at this point in time so that we can navigate this whole maze. But first, we're going to start with who we should blame.
John Burrow once said, "A man can fail many times, but he isn't a failure until he begins to blame somebody else." Despite these wise words, we are in the age of Trump and Brexit. Therefore, let's start to point fingers.
Most all American expats have had many negative ramifications from the Foreign Account Tax Compliance Act, also known as Fatca. In fact, it might have led to the closing of your brokerage account in the United States, or even your non-US bank telling you to go elsewhere.
So it's Obama's fault, right?
Not exactly. When you follow along with Fatca brought about, it's really introduced ways that American expats could get caught while not declaring taxes, owning Pfix, or even not declaring taxes that were owed.
So if Obama just built a means to catch non-compliant individuals, why did everything change for expats in 2010?
Well, rules from past presidents started to be enforced. Ronald Reagan, beloved president that was in favor of cutting taxes, added a huge tax to American expats with foreign investments with the introduction of Pfix rules, also known as passive foreign investment companies. These were designed to prevent Americans from owning managed vehicles from foreign jurisdictions.
So what about the notorious Nixon?
In 1970, Richard Nixon signed into place the Bank Secrecy Act, and American expats had to report all foreign bank accounts that aggregate to over $10,000 US. They have subsequently never increased this amount to meet inflation growth. If you haven't provided these documents, they can lead towards large fines. All the while, no tax is ever owed on these declarations to the Treasury Department. Until Fatca, Nixon and all subsequent presidents had no means to police the foreign banks and to enforce the rules.
For the sake of pinning the blame for the frustrations behind being an American expat, we blame Abraham Lincoln.
Lincoln may have abolished slavery in the United States, but made any American that moved out of the country de facto slaves, of which no other country other than Eritrea follows the logic, and even Canada has banned them from being able to do so. Abraham Lincoln introduced citizens-based taxation with the first income tax signed on August 5th, 1861, and was a measly 3% of income to help fund the North in the Civil War efforts. All of the above culminated in what is now known as the Fatca Accords established by Barack Obama. This law was designed to increase the compliance of U.S. taxpayers that had reporting requirements for financial accounts that were held in foreign jurisdictions. To ensure compliance throughout the chain, the new framework imposed legislation onto both the individual and the financial institutions that service the U.S. persons. This led to the stricter reporting standards and larger penalties being imposed for non-compliance. With the newfound power in place, the Fatca Accords essentially became the international policing force for U.S. persons with foreign accounts and assets. With over 113 countries having signed up to comply with the U.S. Fatca rules, and an additional 200,000 plus institutions having registered with the IRS.
I hope that video really sets the tone of exactly what we're trying to get across today, and puts it in a little bit of a nicer frame. The last 10 years with the introduction of FATCA has been very difficult for a lot of you as Americans abroad. And you probably are well aware of what FATCA really is, which is essentially a sharing agreement that the country that you live in needs to and has to share that information with the United States, and therefore they might have changed what they're willing to do. And the problem is, it doesn't just affect US citizens, people that talk and act like I do. It impacts anybody that moves over to the United States and becomes resident in the United States. It impacts any green card holders, even if they're not living in the United States at that time. And it definitely impacts all those people that have dual citizenship. So just because you have two passports doesn't mean you can pick and choose when you use one. So make sure that you're aware that you need to conform with all of these types of rules. Now, knowing that you guys all work with American Overseas, I know that you've got your FBAR reporting taken care of, but this is one of those just easy marks because it's not a tax, it's just a document that you have to do once a year, reporting any accounts that are over $10,000. The main reason I'm bringing this one up is because of that last point. It's been all over the news. Bitcoin cryptocurrencies have gotten to an all-time high. Not advocating them. I'll get to that at the end of this presentation, but it used to be that you don't have to report them on your FBAR, and right now it's being debated whether that's going to continue to be the case. So keep your ears open to that one. Keep asking your tax accountant, keep asking your friends over there at American Overseas about how you should be reporting your FBARs, but definitely report any accounts that in aggregate, if all your accounts are over $10,000, you have to report all of them. If you're on a charities account, if you're on a business account, those are all included. And it's just big penalties and a big pain if you forget to do so. So make sure to take care of that. Many of you, today we're talking about investments. Many of you have had different letters or different views from your local banks that basically say that they don't want to take your accounts anymore. Now, this can be really annoying, but essentially, this is actually probably the best thing your bank can do for you, because almost any investment that is purchased outside of the United States is going to be considered a passive foreign investment company. When you own a passive foreign investment company, even if you take a QEF election or the likes, you're going to end up paying a lot more taxes, and you're not going to get some of the best benefits out of investing, i.e. being able to capture losses from positions that go down and offset your gains. And therefore, you're going to pay a higher tax bracket in the United States. And some people, if there's anybody dialing in from Belgium, we don't have a capital gains tax in Belgium. So it becomes extremely cumbersome to pay excess tax in America. So if you never invest in a Pfix, you're most likely doing much better than anybody that has one of these. But if you happen to have invested in one by accident and you're getting calls from your tax accountant, we can most likely help you try to roll out of it in the best period possible. But for those of you that have never invested in any European entities, we would recommend not ever doing so that you can skip this section of the presentation. If we're not supposed to invest in our European institutions, where should we invest? Well, How we manage this for our clients is we invest either through US entities or we go ahead and use structures that we're buying those over here in Europe. So for the most part, we're actually buying our investments in the United States with a company that's willing to use a foreign address. There's 5 reasons why we suggest doing so. The first one is just what we talked about, to avoid Pfix, to avoid that excess taxation that's going to go through the roof. The second one is a 1099. Now, a 1099 is a reporting document in the United States that essentially makes it a lot easier to report your US taxes. And in most foreign jurisdictions, makes it easier to report to those foreign jurisdictions as well. By having this 1099, you don't have to construct one on your own. The third reason is if we invest in the United States, that FBAR that I talked about earlier, that we have to report the high watermark of any account that's held outside of the United States, doesn't have to be reported because the US already has access to it. So it makes our lives a lot easier because we have one less document that we have to consider in that way. The fourth reason becomes safety. Now, the United States has been known for big bank failures. It's been going on since the Great Depression, even before. The thing is, after the Great Depression, Joseph Kennedy, John F. Kennedy's father, became the first head of the SEC. And different units were formed to provide FDIC coverage for the banks, SIPC coverage for the brokerages, and a protection agency that if one bank failed or one brokerage failed, the others would take it over through those instruments. This means that we know even when we had huge failures in 2008, like Lehman Brothers and Bear Stearns, those Lehman Brothers clients were moved over to Barclays. Those Bear Stearns clients were moved over to JP Morgan. Those structures are really important to the soundness of the American system, and it gives us that protection. And when we compare that to some of the European units in which we're talking about every couple of years, what will happen if this bank fails, where we're dependent on the politicians, I feel safer knowing exactly what will happen when something fails. So all of a sudden, the safety of our assets becomes something that's nice and prevalent. But the last one, I think, is actually the great news. Most everything costs less in America than it does in Europe. There's several reasons for that, and investments are no different. So by buying in the United States, you're most likely getting much cheaper pricing most of the time when we're comparing a PFIC that somebody presents to us and shows us versus our investments that we're conducting in America. Ours come up much cheaper on top of the first 4 reasons. So there are some benefits of being an American. But there's some downsides of just investing directly in America. And the big one is naturally currency risk. We're investing in US dollars, but you might be living and you might be retiring on euros. There's different strategies that you can use for these. I won't cover the first 4 too much in depth because future contracts, forward contracts, options, and swaps are wonderful if you're hedging something for a year or 2. So let's just say you have all your money in US dollars, you're buying a house next year in euros, and you want to just make sure that we've hedged that currency risk for that year. We can use one of those types of instruments. But if we're investing for 20, 30 years for retirement, even longer maybe, we're really going to want to be more reliant on what are called natural hedges. Now, the way to explain a natural hedge is by first starting out with how the world's stocks end up looking like. The same comparison can be made with bonds, but we'll do it with stocks. Now, when we look at the breakdown of the world's market cap, so market cap being how big companies are, and we divide it around the world, 57% of the world's market cap ends up being US companies. The UK, 3.75%. Europe comes out to about 14 or 15%, and the rest throughout Asia, Africa, Australia, Japan, and Canada. Now, when you look at that, and if you compare that to an allocation that you might have seen when you looked at your US statements, you would have probably found that 85 to 90% of your securities were in US dollars. That over allocation towards the market capitalization is exactly what that natural hedge is. In other words, you own more in dollars because the majority of US investment firms are investing for Americans that are going to retire in America. And therefore, they've naturally hedged to that currency. The same thing happens if you walk into most any European bank. They're going to give you an allocation that's much larger than 15% in Europe. They're probably going to give you 50 or 60% in euros. And that naturally hedges, it reduces that currency risk, making it so that it's easier to plan for your retirement. So that is what we consider natural hedging. And that is one of the obstacles that we help you with in our portfolios. But let's have a little bit of fun with how currencies work and go into what the long-term trends might be. And I think the most fun thing to compare when we're looking at currencies is the Big Mac Index. Now, the Big Mac Index is a tongue-in-cheek index that the economists put out back in the 1970s. It was an easy way to measure what's called PPI, Purchasing Power Index, which just means how far does a dollar go versus a pound versus a euro versus any other currency. And what they did was they just started to compare how much a burger costs in these different locations. And what they did was they evaluated all across the board. Now, over the course of time, this has actually become a pretty accurate rendering of the PPI. I see a quick question there. Will the recording be shared? Yes, we'll be sending this out, and Linda and Dan will make sure that you get the email with the YouTube recording. So don't worry if you have to skip out early. So essentially, when you look at the different currencies across the board, this gave us a leading indicator and a more fun indicator than talking about PPI. Now, one thing that I'm going to point out to you is that you'll notice doesn't matter if we're talking about developed countries or emerging countries. The American dollar right now is extremely expensive. So looking at the last 10 years since we've had Fatca, it's easy to look at that because, well, why don't we go a little bit further than Fatca? We used to have what was called the gold standard. Now, the gold standard went on for years after World War II, all the way until the French called out President Nixon on printing too much of their currency. Now, that was illegal under the current treaty. And when Nixon got called out on it, he decided to get rid of the treaty, i.e. to get rid of the gold standard. So since the 1970s, all the way until 2008 under Obama, we had a dollar that was going down relative to global currencies. Wasn't the euro just yet because it was just the ECU around, but the ECU was nearly at parity and it went all the way up to the 140s. So we're talking about a significant move over 4 decades. Now, during the financial crisis, what happened was everybody flocked to safety on their currencies. And so 7 currencies basically were what bought up during those hard times. The US dollar, Canadian dollar, Norwegian crown, Swedish crown, British pound, Swiss franc, and the Australian dollar. Right? Now, at that point in time, that was where the safety was. And then we had a commodity shock in 2014, where the Australian dollar and Canadian dollar are really supported by their commodities. And so they fell out of grace. We all know about Brexit. That really pushed down the pound for a good 4 years. So when COVID came around, we only had 4 safe currencies: the US dollar, Swiss franc, Norwegian crown, and Swedish crown. Those became the safe havens. Noting that 3 of them are quite small, most of that money ended up circling into the dollar. And as it circulated into the dollar, essentially what happened is it propelled it up. So we've had 12 great years of the dollar going up. So if your portfolios are heavily in US dollars, you've loved the last 12 years. But we need to remember the part in history before that. And since August, we've seen the dollar going down to the euro. You'll notice that most economists actually believe that the dollar will continue to come down just because it was so elevated because of this story of the last 12 years. and therefore it will deflate some, i.e., the cost of our hamburgers should be pretty much equivalent to every place else in the world during normal times. But essentially, when we're living and retiring in Europe, by building a portfolio that's naturally hedged towards euros, we're able to remove that currency risk so that this doesn't have to be the focal point of your portfolio. You're managing it towards that risk. That's why we concentrate so much on natural hedging. I'm going to touch on some other little financial planning aspects before I go into how the portfolios look. And the one is Social Security. Now, Social Security, you have some great advantages in that essentially there's a great totalization agreement between most US countries, the US and most European countries and the UK. If you have a totalization agreement, you don't have to worry about reaching those 40 minimum credits. And this is a huge advantage to you because you can hop around from country to country and you'll receive all those pensions in between. But keeping good records of this is the key because most of the time you have to go to the Social Security office to state that you're eligible instead of them telling you. So make sure that that you access those. You'll find some different articles that I've written on LinkedIn that include all the contacts over there at Social Security and how to use them. Now, essentially, how do we manage our portfolios? Well, very simple. We go ahead and we use a series of different platforms that are either in the US or compliant with everything in the US. They can build general investment accounts, which is just like an individual account. We can use trusts, but you will have some odd conversations with your local accountant or local lawyer because in many civil law countries, trusts are not allowed. This isn't such a problem because most countries like France or Belgium will just look right through the trust if you have a trust, which a revocable trust in the States is exactly that. So those become applicable accounts. For those of you here in the UK, we do have ISAs and SIPs that you can go ahead and build those US instruments inside. They become a little different in restriction, but the key component is that currency. But you want to make sure that they're IRS compliant and that they're producing those 1099s to make life easy. We focus on three major currencies: the euro, the pound, and the US dollar. How do you select which portfolio you should be in? Simple. Where do you think you're going to end up needing the money? So if you're working in Europe, but you know you're moving back to the US at one point in time to retire, we want you to be in those USD portfolios. Whereas if you're living in the UK, but you're definitely retiring to Europe, we need you in the Euro portfolios. If we don't know which one we should be in, it's an easy conversation with us. The analogy that I like to use, naturally we've been invited by a group of Dutchmen and Dutch ladies, so we have to have some sailing analogies. If we're going from Amsterdam to the United States, but we don't know whether we're going to go towards New York or Miami, we're going to sail towards North Carolina, halfway between, because then we can decide on the way there. Whereas if we sail all the way to New York and change our mind to go to Miami, we have to totally change directions. So using this analogy, if we don't know whether we're going to retire in Europe or in the United States, maybe we build two portfolios, half in the euros, half in the US dollars. And as we change our mind over the years, we shift it towards 60-40, 70-30, or maybe just switch it entirely. That way we can monitor that risk and minimize the risk in the best of ways so that we don't have to cover twice the distance. We have 6 risk models inside of each of our portfolios, from conservative all the way up to aggressive. Naturally, this is dependent on your age, your finances, and how much risk you'd be willing to take. So we don't want to see somebody that would panic at little market movements in an aggressive growth portfolio. But we have a nice, easy risk assessment calculator to help you calculate which account would be best for you, and you can have a conversation with any of us on which one you should be in. This page just shows you in the burgundy the amount that we have in US dollars. So you can see the USD portfolio is majority US dollars, whereas the GBP and Euro portfolios are not. That is always going to be the case, and that is what you're really buying with us, is you're buying a portfolio that's allocated in the way to minimize your currency risks while being compliant in the US. If you go to our website, you can see one of our selective services is through Premium. And you can see from this page what our portfolios selection looks like. And if you click on any of these different pages, you'll get a 2-pager on that portfolio model. That doesn't necessarily mean that that's going to be the end-all be-all for your portfolio, because sometimes you might have positions in your portfolio that have a low cost basis. We would transfer those in and we would hold those inside of the portfolio instead of just selling them directly. This is our risk questionnaire. When we send out this presentation, you'll be able to click that link, and if you want to take the risk assessment, you'll be able to, and you'll be able to see the parameters of how much they would shift up or down.
In 2007, Warren Buffett made a bet of $1 million that an index fund would outperform a collection of hedge funds over the course of 10 years. And of course, he won. With that said, the market often represents opportunities and risks that are hard to ignore. So how can I have my cake and eat it too?
What is core? The core of your portfolio is a bit like a tree trunk. Having a strong trunk will allow the tree to weather a number of storms and in turn continue to grow. This analogy does not only apply to trees in the forest, but can also be applied to your portfolios. A well-diversified portfolio will have a number of strong core positions that act as the trunk of the portfolio.
What are the satellites? Sometimes an opportunity in an individual stock, currency, or other investment presents itself, or even excluding a certain portion offers an opportunity in the marketplace. The key towards having good satellites is that they remain smaller positions of the overall portfolio, so that you don't lose your overall diversification. At Dunhill Financial, we keep all our aggregate satellite positions to under 20% of the portfolio at all times. And in normal times, we would prefer to have no satellites. I miss those normal times.
I think I speak for everybody on this presentation when I say I think we miss those normal times as well. So essentially, that is how we look at portfolio management. The majority of the portfolio should be long-term investments that we just recalibrate and we reinvest it and we rebalance it each year. But we have a small portion that in certain economic times, we make different changes. Naturally, last year, we made more changes to our portfolios than we ever have in the last decade. And that's what this last segment in this discussion is going to be about, is the last year and how we behaved and how we look at our portfolio in the next year. So the key takeaways that I really want you to take away from this segment is that, first of all, the market comes back. It's independent from the general economy. So we're going to discuss those types of things. We don't ever want to fall into the trap. You know, Mark Twain said it best that history doesn't repeat itself, but it sure does rhyme. This time isn't different. So when we look at certain segments, we're not going to sit here and say, well, everything's changed because it's 2021. And then we want you to go through feeling confident that we have a good view on 2021. Naturally, 2020 seemed like a disaster from the beginning all the way to the end. But coming into 2021, we got some changes that helped us a lot. When we look at COVID numbers, we don't look at regular charts. We like to look at the exponential growth. And when it falls off this curve, essentially we know that countries are getting back towards normalcy. So that's where the Chinas, the Hong Kongs, the Australias, the New Zealands have done really well on curbing that exponential growth. And yet many of the developed markets are struggling somewhat. We know that our economies are going to be correlated to these issues, the main COVID issue. But at the same time, some of the parts of the stock market are totally disassociated. And I think this is the interesting part of how we build up an index. So if you look at the S&P 500, 23% of it is made up of 5 stocks: Facebook, Apple, Amazon, Netflix, and Google. Also name the FANGs together. And as you can see by the big bubbles, those were where the big growth factors came from last year. So where 2020 looked like an incredible year in the stock market, it was really that COVID provided a lot of those companies the opportunity to grow a lot. Amazon doubled their revenues, so obviously the stock price should double. Apple, Google, their search engines and cloud computing helped them grow a lot of revenue in a time where the general market was contracting. So we shouldn't be surprised that that was there, and that doesn't necessarily mean that there's a bubble, because when I compare that to 2003 in China, where we had an epidemic instead of a pandemic with SARS, the technology companies did just as well, and they continued growing thereafter. Once people get addicted to buying online, they don't stop just because the stores reopen. And sadly, a lot of those stores are not going to reopen, so they'll still have that competitive advantage. That being said, the general economy doesn't matter where you are in the world, except for China. We're talking about a retraction. This turns into what we call a K recovery. Remember last February, everybody went down. The economy and the stock market went down. The stock market's fully recovered. The economy's still down in the slump. The UK had its worst year ever in history. So we're not talking about something that's short and light, but the rest of those stocks, the 495 stocks on the S&P 500, stand to recover when the economy starts to do better. Some of them will take time. In our next economic update, we have a great slide that will go through each of the years of what our expectations are for 21, 22, 23. And believe it or not, certain industries like the airline industries are not going to get back to normal until 2024 by our expectations. So these are long-term trends. These are economic aspects, but just because the stock market looks like it's up doesn't mean that it's up. If you take the S&P 500 and even weight it, so meaning that every company's 1/500th, it only made 1.5% last year versus the double-digit returns that we saw when you market cap weight it based on those 5 stocks: Facebook, Apple, Amazon, Netflix, and Google being worth 23% of it. So we don't want to get stuck on just the views of what we see on the front page of the newspaper. We want to look underneath it and see how it works. The second thing that we really need to take of last year is that the central banks started printing a lot of money. We're talking about Biden putting out $1.9 trillion worth of stimulus spending. Now, these are astronomical amounts of money, and naturally, when you pump that kind of money into the system, it helps all boats rise. So staying on the sailing analogies, all boats rise in a rising tide, and if you're spreading out more money, it's going to help all those boats rise. So we can't ignore that in any way, shape, or form on that vantage point that's going to help all those companies move out. So what did we do last year? Well, simple. In February and March, we moved out of real estate. We still haven't gotten back in, and I don't know if we will, because we don't really know how real estate's going to behave, how big cities are going to behave, the Londons, New Yorks, San Franciscos of the world, when it comes to retail, when it comes to office space, and the likes. So therefore, we've decided to stay on the sideline for that, and we've been very happy to do so, because we shifted a lot of that money into our e-commerce stocks, into payment platforms, companies that are doing tremendously well and will continue to do well even after the pandemic is over. And it's not just your Amazons, but you have your Shopify up in Canada, you have your Alibaba over in China, Mercado Libre down in Argentina, and we don't invest in it, but you've got Allegro over in Poland, which is now representing the e-commerce on every corner of the globe. In the payment platforms, we'll talk about it in a little bit, but essentially we have your PayPals, your Visas, your MasterCards. These are the companies that are doing tremendously well because people are buying more online, and therefore we're shifting off cash. Every single government wants to get off cash. Well, except for Italy, but Italy's always a little bit of an exception. Everybody's wanting to get off cash because it's easier to collect taxes when you do so. We started building hedges in gold and silver, and the last one is eggs. Now, gold and silver is not because we're speculating that they're going to go up. It's in fact just the opposite. We're hedging our currency risk, because if currencies all have a shock at the same time, gold and silver will perform better than any of those. So we'd actually love for those positions to do horribly bad, because that means that the currencies have all held up. And when so many governments are printing a lot of money, we want to have those hedges. Think of our gold and silver like our positions, buying automotive insurance. You hope you never use it. If you do, it means you totaled your car. So it means that we've had some big currency shocks. Eggs is a little different story. Now, the story on eggs is that if you go into a grocery store, there's 110,000 items in an average grocery store. And if you're predicting inflation, the item that's going to grow the most when you get inflation are blueberries. So if you see a lot of inflation, go buy your blueberries. You can also buy, there's a couple farms that you can buy through the stock exchange that buy blueberries. If you're predicting that we're not going to have inflation, you want to buy potato chips. Sometimes they reduce the amount of potato chips in a bag, but for the most part, essentially, they never increase the price of potato chips. The only item out of 110,000 items in the grocery store that grows lockstep with inflation are eggs. So eggs become that perfect factor when we're just trying to hedge inflation risk. We're not predicting it. We're just trying to hedge it just in case all of this stimulus increases our potential for inflation. Now, we've bought a big egg farm in the United States, and that gives us that exposure to hedge that portion. We've already talked about how we expect the US dollar to go down. So this is where last year we increased our exposure, not only to developed markets outside of the US, but emerging markets as well. Emerging markets are so important because more than 70% of those emerging markets hold their debt back in the US, in US dollars. So if the dollar goes down, the cost to service their debt goes down as well. And therefore, they have an easier time meeting all their bills. So we love emerging markets when the US dollar goes down in value. What should we be expecting this next year? Well, it's no surprise that we're playing in the green energy space. We want to buy wind turbines, solar panels, et cetera, et cetera. Not so much Tesla. Tesla's gotten into that expensive speculation side of things. And essentially, we want to be more in the energy production side of things. These have done very well. And with the stimulus that Biden's putting forth, that we're seeing throughout Europe and the UK, we expect them to continue to do well. We are still looking at real estate, hospitality, tourism, leisure, and travel. I'm not going to be upset if we're late to the game, because as we've seen with COVID, we get a lot of false starts. And so we'd rather be late than too early, rather than too early. Now, a lot of people are talking about the fact that we're overvalued. We're using a metric here called the Shiller PE, which just averages out, according to inflation, over a 10-year PE multiple. Now, PE is a price to earnings gauge. So the more you're paying for a company, the more earnings you should receive. And these change over the course of time. On average, this would be around 17 or 18. And as you can see, we've climbed up to 33. Some of these aspects we're not so afraid of, because with a declining dollar, nearly 50% of earnings for S&P 500 companies come from abroad, and therefore we would expect that to curb some of that valuation. But the other part, Shiller, who is an economist at Yale, one of the Ivy Leagues, he has basically put together an adjustment for low interest rates. And he brings that to the point that we would be around a 21 or 22 range instead of in the 30 range. So he's not calculating that we're so overvalued when you compare it to the bond markets. Now, we more concentrate on the other side of things, which is the expectations for the S&P 500. If you look at the average expectations of the analyst, they believe that essentially we should have 22% growth in revenues for S&P 500 companies. So that puts us at a point where we could grow back into these levels. And if COVID comes due a little bit sooner, that could actually be very accretive and very attractive. I promised you I'd talk a little bit about Bitcoin and cryptocurrencies. It is the big news item as of late. But the thing is, when you think about a cryptocurrency, it is buying into an empty vessel, a structure that we have no basis of valuing it. So asking me what cryptocurrencies should be worth in the next couple of years would be like asking me who's going to win the Super Bowl. Well, I know who's going to win the last Super Bowl because it was last weekend, but essentially we have a flip of a coin. Now, we look at the whole revolution with cryptocurrencies and Bitcoin, et cetera, as an exciting factor when it comes to technology. But we don't see it as an investment opportunity directly. We look at it more like Levi Strauss did back in San Francisco in 1849. In 1849, there was a huge gold rush over to San Francisco. And as everybody flocked over to San Francisco, they were all hunting for gold. And Levi Strauss was selling them picks, axes, and as you know, blue jeans. We still talk about Levi Strauss to this day. I can't name one gold miner that made his riches from the 1849 gold rush. We see the opportunity in the same way when it comes to cryptocurrencies. We love companies like PayPal and MasterCard that are heavily investing in building platforms for people to trade Bitcoins. This is because the trading spread on Bitcoin or any cryptocurrencies is around 2%. And when you're spending 2%, that means if you're buying one share of Bitcoin at $50,000, you're paying $1,000 to buy it and $1,000 to sell it. That makes it one of the most profitable places for somebody to make money off investing next to real estate. Real estate, 3% on each side. So this is why the financial players are loving cryptocurrencies, because they're making huge spreads versus in the stock market where you're basically paying nothing to get in or get out of those pieces. I'm going to round out the presentations with a few different pieces that you should be aware of. Now, we've got a great video on our YouTube channel. It's Dunhill Financial for YouTube, which just takes you through all of the 7 criteria, the 7 things, the 7 questions you need to ask before you hire a financial advisor. The first one, you need to make sure that they're a fiduciary. Very important. Fiduciaries essentially have to act by law in your best interest instead of their own best interest. The second part fits into that of being a fiduciary. Do they receive any fees or commissions from anybody else other than you as the client? If they're selling you a product, if they're selling you a mutual fund or a UCIT and they get the commission from that provider, they could be influenced by how much they get paid depending on which product they sell, making them the client and you the product. All right? So you want to make sure that they're receiving 100% of their fees from you so that you know that they're a full committed fiduciary. The third portion is fees. At the end of the day, fees can make or break a portfolio. So what we did was we analyzed all the different players out there. And what we found is that they went from 35 basis points all the way to 2.8%. Now, the 35 basis points is basically a robo-advisor We have a product very similar at 50 basis points. And the 2.8%, I don't see how anybody could make money on a portfolio at 2.8%. That made the average American expat financial advisor go for 1.24%. Depending on which side of our business you use, you're either going to pay 0.5% or maximum 1%. And that basically means that you're all in taken care of. That's 1% for financial planning or 0.5% if you're just needing help getting the investment set up and you don't need any financial planning help. Other questions for an American expat advisor, you need to make sure that they're SEC regulated. If they're not SEC regulated, they can't buy in the United States. Therefore, you know that you're going to probably end up with a Pfix. You'd also want to make sure that they're regulated through their your home country so that they're able to give advice and that they're knowledgeable about giving advice to somebody in Europe, the UK, or whatever it might be. If they sell Pfix, we don't see how they could be a fiduciary. So we would avoid anybody that sells Pfix. And then through BrokerCheck, you're able to see if they have any past regulatory issues. And we'll give you the link for BrokerCheck. This is our platform that you can access.
Welcome to your personal financial website, the window into your financial world, where you can see up-to-date information on your accounts, net worth, investments, goals, spending, and more. Start in the organizer. Enter your essential details, upload photos of your family members and personal possessions, and connect to your financial accounts, all for a clearer picture of you. In the Goals tab, add your financial goals, track progress toward funding those goals, and visualize how your goals impact your long-term financial outlook. Monitor your daily cash flow transactions and create budgets to help you stay on track, all from within the Spending tab. Learn more about your asset allocation and see the current values of your holdings from the Investment section. Here you can drill down into your asset types for a detailed breakdown of each of your investments. The Vault is your secure digital document storage repository. Upload all your important and legal documents so you always know where they are and have access to them anytime from anywhere. Your personal financial website is filled with features that allow you to take control of your financial life, so take the time to explore. And if you need help, it's always just a click away in the top right corner of the page.
So as you can see through the use of our technology, you'll be able to link up all of your accounts, even if you have old 401ks, old bank accounts in the United States, and you want to utilize those, you can get them all one view and get yourself financially organized through our dashboard. Great tool to be able to utilize. Another organization you've probably seen Dan and the whole group of American Overseas doing some different recordings with American citizens abroad. I happen to sit on their advisory committee, and I would very much recommend that you all check out their website and even potentially join them. They are our advocates. Mary Louise is literally our lobbyist in DC that talks to congressmen and senators about all the issues that we face. They started back in the 1970s and helped us all get the right to vote. And I hope that you're all voting so that we can go ahead and get some of these other aspects rectified. And I'll get to the biggest aspect that they're working on. You'll get a link to our American Expat Financial Guide, which is a good 20-page document that just slowly takes you through all of these things that I talked to you about very quickly, FBARs, Pfix, and how you should be investing. So a nice little read. I'm not a tax accountant. I'm not pretending to be. Ask your tax accountant about Pfix. We've also included a link for a tax accountant on their views on Pfix. I've never seen anybody with any other views on those. And then naturally, Americans Overseas, you're your first place to go for all your American issues. You know that team well. BrokerCheck is a great place to be able to check out our background and any other firm that you're looking at. We're not the only players in town, but make sure that you look at what's in that background. The IRS website has all the double taxation treaties, and you want to look at that before you do investments from those different sides. And the last one is something that we're working on with American Overseas and ACA, AARO, and several other organizations. This is our coalition of trying to get more towards residency-based taxation. There's not much information on that website. We just rolled this out a couple weeks ago, but we're very proud of it. And you should be aware that we're all trying to work for our greater needs. A little bit of information about us, some links that you'll be able to find, some past articles that we've put out. But now I'm going to roll it out to any questions that you might have in there. I'm going to also ask Linda and Dan, if you're still there, if you want to unmic yourself and if you have any questions, or if there's any questions directed towards Americans overseas. I see one question in here. Is there a minimal starting investment or monthly contribution? No, we have different programs for just about everyone. So depending on the size of your portfolio, you can start from zero. If you're starting from zero, we just ask that there be a monthly contribution or a regular contribution. And it just depends which provider we would utilize and which program we would have you in. But that can all be found directly on our website, but you can start at any valuation when you're coming in from American Overseas. Avi, do we have some other questions that are unanswered? I saw that you were answering a lot of them in there.
Hi, everyone. All of them are answered as far.
Well, we got to have some more questions going on there. Let's see. Oh, that's...
Jeroen is asking whether the fee structure can be explained.
So we have two different business lines depending on your needs. One of them is asset management, and one of them is financial planning. Now, asset management is just you saying, I have this amount of money, I need to get it invested, and I don't need any other assistance. So you say, I want to send in $50,000, $100,000, $10,000, whatever it might be. Now, that fee structure comes out to 0.5% per year. So it ends up being charged quarterly, which means it's 0.125% per quarter. Comes directly out of the account. For the fees, you get the invoice for each quarter. So just to put that in context, that means on $100,000, it costs you $500 per year. The account goes up, the fees go up. The account goes down in value, the fees go down, i.e. we're sitting on the same side of the table. That is from the asset management side of the accounts. Now, if you need more help on structuring, what do I do with my old IRAs? What do I do with my 401ks, et cetera, how much do I need to save? That goes into the financial planning side of things. If the account's under $100,000, we do charge a retainer of $100 a month. Most of the time, we'd rather just take you through the structure, have you on the asset management side until you get over that 100,000. From 100,000 to $500,000, it's 1% per annum. $500,000 to $1 million, it's 0.8%. $1 million to 2.5, 0.7, 0.6, up to when we max out at $25,000 in fees. If you hit $25,000 of fees, we no longer raise them at that point in time. So it is just one basis on that. You can move from one program to the other whenever you want. So if you start as a financial planning client, but you're not using any of our financial planning, you just downgrade it to save on those fees. Same thing with the upgrading. Does it include the investment funds? For most of our platforms, it does. So our main platform in the United States, that includes all the ticket fees. Our main platform over here in Europe and the UK, it does not, but they aggregate the fees for the number of people that are trading on that day. So for the most part, it is quite de minimis. We quote it in a worst case scenario instead of what it usually ends up being. Dunhill came out one of the best here. Oh, that's very nice of you, Linda. Let's see. What other questions do we have, Avi?
So we've got Eric Martin asking about European mutual funds being treated as US for tax purposes. And he is wondering how that can be set up to avoid more US taxation than one should on European mutual funds.
Well, I'm not, like I said, I'm not a tax expert, but I think what you're referring to is the QEF election on your US taxes. Now, I still find that the QEF election charges more in taxes than just setting up structures in the United States and investing it in the European style. So in a tax perspective, it becomes more cumbersome to actually do the election, and in most calculations, a little bit more costly. I think Avi has finished an article on that exact subject, or he's just about to finish it, and I'm sure he'd be willing to send you a copy that will analyze those 3 different ways: PFIC, QEF election, and then just raw investments in the United States. Barbara seems to have a question about Vanguard funds. I've noticed that they just have been purchased on the European subsidiary of Vanguard. Is it true that it does not mean that they are PFIX after all? So if you buy from Vanguard Europe, I think their big office is over in Paris, essentially it will be a PFIC because you're buying a European UCIT. If you buy it on the US exchanges, it's not a PFIC, but it depends. If you're buying a mutual fund, then it's not MiFID compliant, MiFID being the European rules. If you buy an ETF, it depends which provider will say whether it's MiFID compliant or not. Now, that essentially breaks it down to where we haven't ever seen a European carrier, or I'm sorry, a European country fine somebody for something not being MiFID compliant. But we all know that we have a bunch of jurisdictions that would love to tax people more, especially people that are less likely to vote. And all they'd be doing is reciprocating the same rules that the US pulls on Americans that are abroad with the PFIC rules, with the MiFID rules. So we've set up our clients to make sure that we're not buying US mutual funds so that we don't ever get stuck in that MiFID situation where we could get trapped in something that would cost us more. I hope that that's just me being paranoid and overly cautious. Remember that Joseph Heller quote, just because I'm paranoid doesn't mean they're not after me. That was catch-22 for you old literary nuts. But essentially, that's why I find it safer to buy in the United States and stay away from US mutual funds, and definitely stay away from European funds. Oh, perfect. Don't worry. I know we covered a lot in a very, very short period of time. We're going to be sending out both this presentation, the YouTube, and the whole slide deck. You'll have all of our contact information, including the entire team over at American Overseas. So if you have any questions afterwards, please don't hesitate to just drop us a line and we'll get back to you as soon as possible. We're also offering complimentary consultations with any American Overseas clients so that we can see if we can help you, if we can help on your situation and get those going. We've got one last question and then we'll have to call it on time. Is there anything specific to look out for when withdrawing from PFIX? Oh, that's a wonderful question, actually. Now, when withdrawing from PFIX, timing is of the essence because naturally the tax is the key. The more money you make over the course of time means the more taxation you're going to pay in the United States. So, for instance, if you have a market drop and you're just selling it to buy the equivalent someplace else, that is a great time to sell the PFIC. So last February would have been a wonderful time to make those switchovers. You also want to concentrate on how it's going to affect your local tax or your US tax. So talking to your US tax accountant and your local tax accountant to try to strategize whether you should do it all as one big withdrawal, or maybe you actually break it up into a few different years, can be a way to strategize on it. But the main thing you don't want to do is you don't want to let it drag on, because the bigger the gains become, the bigger the taxes will become. Avi's just reminded me that we will send you a consultation link so that you'll be able to book directly on our calendar, so that it will make it nice and easy. From there, I realize that we've run out of time. I thank you all for joining us. Thank you, Linda and Dan, for inviting us, and Amanda for inviting us today. We look forward to many more of these, and to hopefully speaking to all of you soon. Have a wonderful day.